Hi, I'm Patu from Freefincal, and let's take a few questions from viewers and discuss them in this video. But before we do that, Swapnil Kande has written two posts. I talked about it yesterday, probably even day before. The first part was published yesterday, everything you need to know about equity portfolio construction. The second part was published today, build an equity mutual fund portfolio with these simple steps. Very few advisors would talk about portfolio construction in such detail, so please do read both posts. I will link them here and also in the description box. So, I've received a few comments about reviewing Axis Small Cap Fund, and the main reason is that Small Cap Fund, this has bet other small caps and has done well in the past 3 years and so on. I will talk about Axis Small Cap either tomorrow or day after in a review article, but there is a catch, so don't get carried away by it. The NAV of a equity mutual fund scheme increases or decreases when the Nifty or the Sensex, that is the market, increases or decreases. How does the NAV of a debt fund, why does it change? So there are three main factors that are involved in the NAV change of a debt mutual fund. On a normal market day, the primary component of NAV change is the interest. So let's say I have a 5-year bond with 10% annual interest. The interest I will receive over this 5 year, we convert to a daily interest, and the NAV of or the value of that bond in a debt mutual fund will increase by that daily interest amount every day. So the NAV will be increased just a little bit, reflecting the interest component of all the bonds in the portfolio. This is the most common reason for NAV change, and it will always be typically positive. There's no reason why there's no way the interest can be negative, so it will always be positive. Then since a debt mutual fund, the bonds in the portfolio of a debt mutual fund are linked to the market, the supply and demand forces in the market will change the value, the current value of the bonds, and that is another reason why the NAV will change. And of course, the NAV can go up or come down. And supply or demand depends on the interest rate scenario and the credit value of the bonds. When I talk about interest rate scenario, it means that, so let's say I am holding a 8% bond, and if there are new bonds available with the same credit profile at 10%, then the value of the 8% bond will become lower, because if I want to sell my 8% bond, I can't sell it at face value, at the same face value of the 10% bond. I have to sell it at a lower price, so the value will come down. On the other hand, if I hold a 10% bond, and the newer bonds have got only 8% interest rate or coupon rate, then my value will increase. I will be able to sell it at a premium. So the NAV will go up and down depending on these interest rate changes. Also, suppose my bond is AA rated, and because the company I'm invested in has some positive news, and its a credit rating goes from AA to AAA, then the NAV will increase, because the value of the bonds have become higher, because I can sell such a bond at higher value. On the other hand, if the AAA rated bond becomes AA, then the value will come down, because for obvious reasons. So these are the three main reasons. I've talked about this in some detail in other videos. You can have a look at it. Directly, the movements in the Nifty or the Sensex or the stock market in general does not have any direct relationship on a debt mutual fund, but indirectly it can have, because when the stock market crashes, then a lot of people will pull out from debt mutual funds because they want liquid cash and so on. That could affect the NAV. That happened in 2008. ETF has got liquidity issues. Can we buy these as mutual funds instead of ETF? No, you cannot. If it is a ETF, you can only buy it via a demat account. You cannot buy it as a mutual fund from an AMC. And if the ETF has got liquidity issue, that means that the price of the ETF and the NAV of the ETF, the gap is too large. In a good ETF, if the price moves up, quickly it should come down. It should be normalized back to the NAV. And if the price goes down below the NAV, it should be quickly brought up. If this does not happen over a period of time, at least over a few days, then the ETF has got liquidity problems. Avoid it. Is there any chance of the Nifty large and mid cap 250 index beating the Nifty next 50? It depends on over what year. See, the Nifty large and mid cap 250 index is a combination of 50% of Nifty mid cap 150 and 50% of Nifty 100. So if you look at this graph, this has got 2333 5-year data points. The yellow line is Nifty next 50 and the blue line is the Nifty mid cap 150. You can see over 5-year period, typically Nifty next 50 is comparable to the Nifty mid cap 150, more or less. So if I compare Nifty next 50 with Nifty large and mid cap 250, typically over 5-year period, the Nifty next 50 would have done better, because recognize that Nifty mid cap 150 is only 50% of Nifty large and mid cap 250. Therefore, over 5-year periods, Nifty next 50 would have done better, but over 1-year period, 2-year period, anything can happen. So it depends on the duration. Should buying a house with borrowed money act as inflation hedge? Oh my god, that can be very dangerous, because many people have this illusion that property prices will always increase. They say that about gold also. Gold prices always increase. That is not true. Property in India has gone through a bubble, especially in many major cities, and rental yields of these properties are extremely low. You will get more money if you put your money in a bank deposit, in a savings bank account. Forget bank deposit. So also the values are not high. It's not increasing as much. There has been a slowdown because demand has come down considerably. And please recognize, if there is a recession like period, then there will be no money to buy property, and property prices will even fall further down. So, and also you're saying you're going to buy with borrowed money, that's even worse. It can be very dangerous. Don't do it. How to defend a portfolio against high inflation like 2012-13? See, high inflation periods will always happen in any economy. Even in the US, there can be high inflation periods for over a few years. High inflation means for them 3% normal inflation, 5% if it becomes, it's higher inflation. That can happen in any economy. During that period, you need more cash flow. That is better to increase more cash flow and handle inflation during that period than to do anything with the portfolio. Because if it lasts for more than a couple of years, then something is terribly wrong. So that in that sense, then you need gold and so on. That's a different. That's a Venezuela kind of situation. We don't want that. For short periods of high inflation, other than extra cash, there's nothing more to be done in terms of investment, in my opinion. During the 12-13 period, the government servants got very good DA increases. So you need higher cash. Is there a way to invest in mutual funds to make money double in 7-8 years of span, just like Kisan Vikas Patra? First of all, Kisan Vikas Patra does not double your money in 7-8 years. That is, if you take into account tax as per slab, it will not be double. So that's the first point. Second point is, market linked mutual funds are market linked instruments, and nobody knows what return they will give you. So it's not possible. So please don't think of that kind of money doubling, compounding 10% every year. That kind of compounding idea should not be there when you invest in mutual funds. Kindly guide, what should I do for investing? Investing is a nightmare. Yes, investing for retirement is a nightmare. Yes, it is. I have several videos on this. I would suggest that you look at them. I will link them here. I don't want to talk about this again and again. I will link them here. Please have a look. Should one take super top up from the same insurer or different insurer is also okay? See, if you take a super top up insurance from a different company, then please recognize, if the super top up insurance is needed, then you have to first pay the money and then only claim via reimbursement. Cashless will not be possible. So from that point of view, if you want cashless transactions for super top up, also getting insurance, getting a super top up from the same company makes a big difference. However, sometimes the super top for some companies, super top up cover may not be very high. They may not give you more than 10 lakhs, 15 lakhs, 20 lakhs, and so on. So if you want a very high cover, then you may need to go for a different insurer. So depending on your priority, you can decide what you want to do. Videos related to certified financial planners, is it good to take their advice? Certified financial planners means nothing. They can still be mutual fund distributors, many of them are. They can still be insurance agents, many of them are. So don't worry about too much about certified financial planner, etc., etc. They will make a big deal about it. That's okay. You go work with a SEBI registered investment advisor who is a fee only financial advisor who does not take any kind of commissions or remunerations from anybody else, whether it is insurance, mutual funds, or anybody else. Then you have conflict of interest, interest free financial advice. I have a list of such advisors. I have a video on this. Please look at that and consult them. Or ultra short term funds of ICICI, Franklin, HDFC, Kotak, safe. I don't know what safe means. If you mean credit issues, safe from credit issues, no. No debt mutual fund or even no equity mutual fund is safe from credit issues. Anything can have credit issues. So no. Have you made a video on what all products an investor should stay away or never fall for? See, please invest only in products that are regulated and where the product manufacturer is accountable to the regulator periodically. So, products from banks, products from insurance companies, products from mutual funds. That is all. You don't need to go to any other product. Simple enough. How should a person decide on asset allocation if he has started investing in equity late and has considerable amount of fixed income, but the person is still young and probably planning for child or retirement goals which are 15 to 20 years away? My suggestion is take over a year or over 2 years and convert the fixed income assets gradually into a 60% equity or 50% equity, 50% fixed income kind of portfolio over a period of year or 1 or 2 years. You can consult a fee only financial advisor for this, it will be much better. That's my suggestion. Vinay has said my robo advisory says ignore existing investments. I don't think I have said that. I also expect the investor from the robo advisory point of view to whatever I just said, convert gradually to equity, but take your time. It depends on your risk appetite and so on. Of course, if you have extra money to invest, then you can leave those fixed income investments alone and start investing afresh for that goal. But most people may not have such extra money. If you have it, go ahead and do it. Oops. We all plan for what to do after success, and there is no contingency or failure plan. What if an investor fails even after investing at 60-40 ratio, periodic balancing and decrease? There is 50% or more chance that he could fail. What should he do in such situations and prepare for such events? See, there are no guarantees in life. You cannot have a contingency or failure plan when you want 10 crores after 10 years and you have nothing. You have to take the chance and invest in equity. You have to do rebalancing. You have to do risk management on all that. Even after all this, you can still fail. That's life. I mean, if you want guarantees, there are no guarantees. That's not going to happen. And if you want guarantees, you can never get rich in life. You can just forget about it. You have to roll the dice. You have to take the chance, but you still have to learn how to manage. This is an interesting question. After seeing my personal financial audit, one person asks, as per this video, I have 6 funds. That is me. I have 6 funds. Is it okay to have so many funds? What is your thought process for such a diversity? I don't have a thought process for such great diversity. Many people think I have great thought processes for everything I do. I don't. The only reason I am successful, I think, as a DIY investor is because I don't think too much. I don't ask other people, is it okay to have this many funds? Is it okay to invest in this fund? I don't care what other people think. I just go ahead and do what I like. So I have 2 goals, and for each of those 2 goals, I have 3 funds each. And please recognize the assets that I have for those 2 goals are considerable, or rather more than what a typical young earner would start investing with. Therefore, I have 3 funds to spread my assets across, and there are 3 funds over 2 goals, so it's only 3 funds per goal. So that's what I am comfortable with. If you are comfortable with one fund, go ahead and do it with one fund. It's up to you. It's your personal comfort. So that's it, I think. Yeah, that's it. So that's it for this Q&A. If you have any more questions, go ahead and post them below. If you have any comments or suggestions, please leave them below. I'll talk about those in coming videos. Thank you. Bye.